The Fed and the European Central Bank will be the main focus next week. We will also be closely watching the May final PMI data across the globe. We have seen the euro weakening below the 1.12 mark against the US dollar this week, and despite the softening Fed expectations, the euro dollar hit a month low of 1.1128 on Wednesday. We may question whether or not there is more potential for a further slide toward the 1.10 mark, as the ECB doves could remain in charge before the European Central Bank meeting due on Thursday. At this stage, we do not expect the ECB to move any further for at least the next 6 months. Given that the recovery in oil prices have already eased deflation fears, the Q1 growth figures in the EU have happened to be better than what we have seen in the US and in the UK over the same period, and the improvement in the European credit market is clear to see. This is also a topic that the ECB President Draghi loves highlighting at each of his press conferences: moderate but sustainable. All in all, the ECB is expected to maintain the status quo at next week's monetary policy meeting. The refinancing rate will certainly stay unchanged at 0% and the deposit facility rate at -0.4%. The ECB is also expected to continue buying €80 billion worth of assets on a monthly basis, which, we remind, now includes the corporate bonds besides the sovereign bonds. From a market perspective, the euro gains could be expected to remain capped below the 1.1220 figure, which stands for the 100-day moving average, and 1.1315, which is the major 38.2% retracement off the February 5th peak of 1.1615. Up to the 1.1315, traders could tend to sell the rallies. The pullback toward the 1.1070, the 200-day moving average, could be a reasonably dovish ECB bet for next week, but obviously comes with a recommendation of not omitting a stop loss at or above the 1.1315, as clearing offers above this level, the euro dollar could easily make it to 1.1450 and even the 1.15 mark. Such a bullish reversal could leave the euro sellers in pain by the end of the week. But the ECB will not be the only driver next week. Thursday's ECB meeting will be followed by another popular release, the US jobs data. The US dollar reversed gains this week as the probability of a June rate hike slightly weakened throughout the week. As of today, the market gives no more than 40% chance for the Federal Reserve to hike rates at its June meeting. Next week, jobs data will be an important test for the Fed hawks because the expectations are rather weak. Coming back to our discussion, the US economy is expected to have added 160,000 new non-farm jobs last month, in line with last month's performance. The unemployment rate is predicted to fall below 5%, with an average 0.2% increase in wages. This is slightly less than April's 0.3% salary growth. A soft read could further weigh on the June hike probability and let the US dollar further weaken across the board, freeing some space for the G10 and EM currencies to take a breather. Finally, we have a series of PMI data coming in next week as we move toward the Brexit referendum, and taking into account warnings from British officials, the UK Services PMI may be an interesting data set to watch. In the G7 meeting, British officials warned that a potential Brexit could weigh on the UK's services sector, as 80% of the economy is in the services industry. Good trade and market access is therefore a crucial argument for jobs and the economy. The UK services sector may have expanded at a slower pace in May, given the uncomfortable and uncertain environment before the Brexit referendum. Last month's read was already a 38-month low, and a read below the 52 level could trigger some selling pressure on the pound, as we will be officially stepping into the calendar month of the referendum.